Well, good afternoon, everyone, and thank you for joining us here today for part two of our September webinar series, Hedging with Options Protective Collars. So my name is Ken Keating, and I'm a principal at OCC Investor Education, as well as an options industry counsel instructor and former professional options trader, floor market maker, floor specialist, risk manager. And I'm going to be giving today's presentation on hedging with collars. So before we get started, we always have to mention our disclaimer. Options are rather complex vehicles and need to be properly understood before trading in a live account. So anyone considering trading options should thoroughly read and understand the characteristics and risks of standardized options, which you can obtain by visiting us at optionseducation.org to download a free digital copy. Or if you prefer a physical copy, you can always reach out to your broker or any exchange on which options are traded. In order to simplify the calculations used today, commissions, fees, margin interest, and taxes have not been included. And lastly, any strategies that we discuss here today are strictly for illustrative and educational purposes. All right, here's all the trademarks and logos that you'll see throughout the presentation. This is strictly for the lawyers at OCC. A little bit about OIC. Who exactly is OIC? Well, the Options Industry Council, who I work for, we are effectively the education arm of our parent company, OCC. So OCC is the Options Clearing Corporation and is the world's largest equity derivatives clearinghouse for exchange-listed options, as well as the foundation for secure markets. So OIC started out as a cooperative in 1992 to better educate the public both on the risks and the benefits of exchange-listed options. And we do that primarily through our website, optionseducation.org. There you'll find our complete free online education. You'll see online courses, podcast videos, as well as additional webinars like the one you're listening to right now. So if you ever have questions regarding the product, you can always reach out to us at options@theocc.com Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time with any and all of your options-related questions. I work on a desk with three other very talented individuals. Collectively, we have well over 100 years of trading and brokerage experience, and we're always more than willing to help you navigate the product and understand the product better. But just keep in mind that as we are not registered advisors, we cannot direct you on trades. We can't critique your trades. However, we can talk to you about general option theory, optionality, option strategy, also how corporate action may impact your options position. So if you ever have a question along those lines, you can always reach out to us. We are always more than willing to help you out. All right, with that out of the way, let's get started. So today is going to be a continuation of last week. So last week we talked about the protective put, also known as the married put. So today we're going to be talking about the options collar, which is really just a combination of two different strategies. It's a combining of the married put, puts in stock, plus a covered call. So when you marry those two positions together, what you wind up with is what's known as the traditional collar. So we'll be looking at the protective put just as a review. We will also review the covered call, and then we will go over the traditional collar when you put those two together. At the end, we'll look at some collar variations, some things that you can do to kind of change up the collar depending on your outlook, depending on your risk tolerance, some creative ways that you can use the collar and position the collar to take advantage of different scenarios. So Q&A will be conducted along the way. So I'm fortunate to have all my colleagues with me. Say hello to Mark Benzaquin, Matt Cashman, and Roma Caldwell. They're behind the scenes answering your questions in real time. Time permitting, I will bring Mark back on at the end of the presentation to entertain any live Q&A. So if you have questions, just pop them in the Q&A box at the bottom of the screen, and they would be more than happy to answer your questions. So with that out of the way, let's get started. All right, so the protective put in review. So once again, the collar is the combination of a protective put and a covered call. So on the downside, it's a protective put. So in review, a protective put is just an out of the money call typically that is used to protect a long stock position. So it provides protection against a decrease in the stock share price below your strike. And typically we purchase an out of the money put, and your strike selection determines where you can exit that price. It's also going to determine how much premium you're going to pay for that put, because any option that you buy, you're going to be paying a debit for that, and that's the cost of your protection. So the beauty of the covered call is that it still allows you any upside profit in the long stock position. So as I mentioned last week, when you take a protective put and marry it with, or put it together with 100 shares of stock, what you've done is you've converted your long stock position into a synthetic call option. And by doing so, now you have limited downside risk. You've defined your risk to the downside, but you still have unlimited profit potential above your break even, which we will go over. It also may allow you to lock in gains on a stock. Maybe you bought at 10 and now it's trading years later at 200, and you've had this huge run, and all of a sudden maybe the stock's going to report earnings and you're getting a little nervous. You could choose to buy a protective put against that long stock, maybe at the 190 strike in case the earnings miss. Now it's a way for you to lock in those gains that you've been sitting on. Also, know that just because you own that put, you always own the right to exercise it, meaning you could elect to exercise it and sell your shares, but you also own the right not to exercise it. So if all of a sudden the stock, the earnings came out and the stock went from 200 down to 150, you own the right to sell those shares at 190. Doesn't mean you have to exercise that put. You could actually turn around and sell that put back into the marketplace, monetize your hedge that way, and use the proceeds to, one, maybe buy additional shares of the very same stock that you were hedging. Two, maybe use those funds to deploy in other stocks. Okay, so you don't always have to exercise your options, but you do have that. You do have the right to exercise if that fits your investment thesis. So once again, this is more in review. So the structure is every 100 shares that you own, you are able to buy one put against it. So that would be hedged 1 for 1. You buy one put against 100 shares because every option is the right to buy or sell 100 shares. So in this case, one put option would cover 100 shares. Your motivation always is to protect the downside of the long stock position. And you put this on because you're still bullish on the shares, but you're a little cautious in the near term. Okay, so it affords you that protection to the downside, allowing you to sleep at night, but ideally, in theory, you really want those shares to continue going higher. Your maximum risk is always going to be defined between the purchase price that you paid for the stock minus the strike price for protection that you use for protection minus any premium paid. So once you do that, you know your risk is completely defined. Your maximum reward is always going to result from the long stock position. So your maximum reward would be the purchase price that you paid for the stock plus the amount of premium for that option that establishes your break even to the upside. So depending on what you paid for that put, it's going to determine what your break even price would be. And in this case, there is no assignment risk. Assignment risk only lies with option sellers. Option buyers can only exercise. So when you own an option, whether it's a call or a put, you're in the driver's seat. You can elect to hold that option. You can elect to sell that option out if you want between now and expiration, or you can elect to do nothing. Or you can elect to manage that position and maybe roll it to a different month or a different strike. So you're kind of in the driver's seat, but assignment risk is not something you have to worry about. All right, so here is that projected put in graph form, because sometimes it's always easier to look at this in graph form. So if we buy stock at 80 and we're a little worried about the downside, so we look to buy an out of the money $75 put, and we see that we can buy this put for $2.70. So our break even, once again, is going to be the price that we paid for the stock plus the premium of the option, $2.70. That gets us to $82.70. So at $82.70 at expiration, if this stock is at $82.70, we would neither make money nor lose money on this position. We would make $2.70 on our stock, and our 75 level put would expire worthless. We would just break even. But as you can see, above $82.70, we have 1-for-1 participation on our long shares. Stock goes to 100, we're going to make, in this case, $17.30, and we have unlimited gains from that long stock position. Our maximum loss is going to be the initial share price, $80, plus I'm sorry, minus the strike price that we chose, 75. So 80 minus 75 is 5. Add that to the 270 that we paid for the put. That gets us to a total maximum loss of 770. So if the stock finishes at 75 or lower, we know what our maximum loss is. It's $7.70. In this case, roughly about just shy of 10% of the value of our long stock position. But below that, that's as much as we can lose. If the stock goes to 50, the most we can lose is 770. If the stock declares bankruptcy and goes to 0, the most we can lose is 770. So once again, that idea that we've defined our risk to the downside and we still afford ourselves unlimited upside exposure above our break even, in this case, 82.70. Okay, so that's the protective put in review. So now let's look at the covered call position. So the covered call is probably the most popular of all the options strategies out there. And it's usually because most people come into the options market already long a portfolio of stocks, and they look to the options market to sell calls against their long holdings to create an income stream, to generate a little revenue. So in the case of a caller, on the upside, on the downside, it's a protective put. On the upside, it's a covered call. So generally, once again, it's used for income. And in the case of a caller, the premium that we receive from selling the call can be used to offset the cost of our protective put. So ideally, we would like the call that we sell to cover the cost of the put that we buy. That would be called a costless caller. So we would be able to put on this hedge at 0, other than commissions or fees, but it would cost us nothing. So typically an out-of-the-money call is sold, and strike selection determines where that stock may be called away. So by selling an upside call against your long stock position, now you have capped your upside exposure or your potential gains. So the only reason somebody would put on a covered call position is if you are neutral to moderately bullish on your shares. That's very important to keep in mind. If you are wildly bullish, you wouldn't sell calls against your long stock position to begin with, right? Why cap the upside if you're very bullish on your shares? By itself, just selling calls against a long stock position, yes, it affords you a little protection to the downside based on how much premium you take in for that call. But by itself, the covered call, the risk lies in the long stock position. So if you're really bearish, you probably wouldn't put on a covered call. But you're really going to only put on a covered call if you're neutral to moderately bullish. You ideally would like that stock to kind of inch its way up to your short strike and just close either at or slightly below your short strike, where you keep 100% of that premium and you had no risk of being assigned. So once again, your profit is going to be limited by that short call. So every 100 shares that you own will allow you to sell one, typically an at-the-money or an out-of-the-money call. In most callers, people use the out-of-the-money call. In this case, the income that we receive from the call increases your stock returns for the covered call by itself. But for the caller, which we will look at, we're going to use that income to offset the cost of the put protection that we are looking to purchase. Your forecast, once again, neutral to moderately bullish. Your maximum risk in this case, with the covered call by itself, is the long stock position minus the call premium received. So if I buy stock at 100 and I sell the 110 call for $2, I've taken in $2. It's lowered my cost basis from 100 now down to 98. From 98 down to 0, I have risk, but it's effectively lowered the cost basis for my long 100 shares from 100 down to 98 by taking in $2 in premium. The maximum reward is always going to be the call strike plus the premium minus my long strike. So if I buy stock for 100, I sell the 110 call for 2, okay? I know I can make, if the stock runs to 110, okay, I'm going to make $10 on my stock. I'm also going to take in $2 in premium from the call. The most I can make is $12. If the stock runs to 150, well, that's kind of unfortunate, but it doesn't mean we won't make money. We just, we've capped our gains at 110. We're only going to make $12 on that position to the upside. But, once again, you can always manage that strategy. If all of a sudden the stock starts creeping up to 110 and you're short that call and you're still really bullish, maybe you could buy back that call and roll it to a higher strike, affording you more upside on your long shares, plus taking in some additional premium from the sale of an additional call to help offset buying back that short 110 call. Assignment risk in this case is central to the strategy, because sometimes people sell covered calls with the idea or with the intention that, well, if the stock if I buy stock at 100 and goes to 110, I'm happy with a 10% move and just losing my shares. So maybe they just target the 110 strike, sell that call, and if they get assigned, they're happy. They made their 10% plus whatever little premium that they made on the by selling the call, in this case $2, so they'd make 12%. Sometimes assignment is a welcome event. Also keep in mind that when you get assigned in a covered call situation, you've essentially made the maximum profit potential you could on that position. That's all that means. Okay, so that's always, anytime you can make the maximum profit on any position, that's always a good thing. So keep that in mind. Also, you're also going to be entitled to any dividends that that stock pays, as long as you don't get assigned on your call before the ex-dividend date. All right, so let's look at the covered call in review in graph form. Let's just say we own shares from 52. We look at our options chain. We don't think that the stock over, let's say this is maybe a 3-week period, maybe a month period. We see that we can sell the 55 level call for $1.75 because we think that the stock has a very low likelihood of reaching 55. So what does that look like? Our break even in this case is going to be the price we paid for the stock, 52, minus the premium that we took in, 175. That gets us to $50.25. So if at expiration the stock is at 50.25, we would neither make money nor lose money. Yes, we would lose $1.75 from our long stock position, but we would make $1.75 because our 55 call would theoretically expire without value. Below our break even of 50.25, you see that we have 1-for-1 losses, because once again, that the losses are real in the covered call position lie within the long stock position. So below our new break even of 50.25, we have 1-for-1 losses all the way to 0. Our maximum profit is always going to be the stock sale price, in this case 55, the strike that we sold 55, plus the premium that we took in, $1.75, minus what we paid for the stock. When you do the math, that's a total profit of $4.75. In this case, just kind of shy of a 10% return on this investment. So once again, if the stock goes to 60, that's unfortunate, but we would make, if we got assigned on these calls, we would still make $4.75. So that's the maximum that we can make on this position. Okay, with all that, let's talk about the traditional caller. So why do people use callers? Well, people use callers for various reasons. So maybe you have one stock that's an overly large percentage of your overall net portfolio. Maybe you worked for a company for years and years and years, and you've accumulated stock, and particular stock, it represents 40 or 50% of your overall portfolio. And for whatever reason, maybe you want to hedge that portion of your portfolio, or maybe a portion, not the whole thing 1-to-1, but maybe a portion of that. That might be an instance when you use a caller. Maybe you do use a caller to protect an entire portfolio. You've had a nice run, you're worried about the near-term downside, and you think there's not so much upside left in the portfolio, at least given the economic scenario or the economic environment that you're in at the point in time, and you're worried about the downside. Now a protective collar might make sense. So in this case, you get protection to the downside from the long stock or long put position, and some limited participation, but remember it's limited because you sold that call to the upside. So the key benefits are the put cost can be fully or partially paid by the call premium received. Remember that we ideally would like to do this for either even money or a net credit. And depending on where you're looking, the further out you go, you're going to have higher and higher option premium. So you're going to have a higher chance of doing this kind of trade for either even money or possibly even a net credit, depending on your strikes, the further and further you go out, because you're going to be taking in more premium to sell that call further and further out. So in this case, your objectives would be met whether the share price is up or down, and any dividends that get paid would be received by you, the long stockholder, pending that you don't get assigned on your short call. But once again, the risk remains in this position in the long stock position, but because we have that protective put up until that long put strike kicks in, and to the downside, if all of a sudden the stock falls apart, we would be protected. We know how much we can lose to the downside. So let's look at an example of this. So let's just say we have a stock price. It's trading for 75. There's 45 days to go to expiration, and we're looking for protection beyond a 10% move. So we look out on our options chain and we see various options trading. So 10% of 75, that's $7.50. So we're going to be targeting the 67.5 put strike. Okay, so market on them is 125, bid offered at 135. Let's just say we're able to, put in a mid-market bid and we can buy these puts for 130. So we're going to buy these puts for 130, and now to offset the cost of these puts, we're going to turn around and we're going to sell, in this case, an 82.5 level call for 90 cents. Okay, so that's going to be a total debit of 40 cents. It's going to cost us 40 cents. Now, yes, we could turn around and sell the 80 strike call for 130 and put it on costless, but in this case, maybe we're a little more bullish. Maybe we want to afford ourselves a little more upside. So we're going to sell the 82.5 call. And by doing so, it's going to cost us a small debit, but it's going to afford us more upside. So what does this look like in graph form? So here we are. We're long 100 shares at 75. We buy the 67.5 put for $1.30. We sell the 82.5 call for 90 cents. It's a total debit of 40 cents. Our maximum profit is going to be the short call strike minus the share price that we paid. In this case, that's going to be 82.5 minus 75. That gets us to $7.50 minus any debit that we paid or plus any credit we received. So since we paid a debit of 40 cents, we have to take $7.50 minus 40 cents. On the upside, the most we can make is $7.10. Okay, and that's what the stock at 82.5 at expiration or higher, we would make $7.10. Okay, roughly about just shy of 10%. Now, what's our maximum loss? It's the share price that we paid minus any long put strike. Okay, so 75 minus 67.5, that gets us to 750. Plus any debit that we paid or minus any credit received. Since we paid a debit, 750 plus 40 cents, that's 790. So if the stock goes to 790 at expiration, if stock goes to 67.5 at expiration, we would lose the maximum on this position, which would be $7.90. But that's where our losses are capped. If the stock goes to 50, we would lose $7.90. Stock declares bankruptcy, we lose $7.90. That's all we can lose. Okay, so we've effectively capped our downside. We have capped our upside, but we've done so for a very little outlay, in this case, 40 cents. Okay, so what ifs? What if the stock price plummets? Okay, well, you can always close the position and free up capital. Okay, you can either, one, all of a sudden the stock falls out of bed. You can always choose to exercise that put, sell your shares, buy back your short call, and just free up capital to live to fight another day. You could also hold the shares. Maybe that put has some intrinsic value left in it. You could hold the shares, monetize your hedge by selling back your long put, okay, and taking those funds to either, one, buy more shares of this stock that you're hedging, or deploy it in a variety of other ways in other stocks you might look to invest in. Okay, so you can always sell back that long put, buy back your short call to monetize the position. If the stock remains flat, okay, well, in this case, if stock goes up right out at 75, you're then the most you can lose is 40 cents, right? So you're not going to make any money on your stock. You're going to lose the 40 cents on the hedge. And you have to ask yourself, am I still cautious? Am I just as bullish or cautiously bullish? You could roll the entire position further out and reestablish the collar. And if shares rally, you have to ask yourself, well, do I really still need this protection? Am I still worried about the downside? Do I want to possibly, if that stock rallies up to my short call, am I thinking, do I want more upside? Am I a little more bullish? Well, you could buy back that short call and just stay long the stock, sell out your out of the money put, and just take off your collar. Or you could roll the whole structure higher. You could, buy back your out of the money call, sell back your out of the money put, and then sell a higher strike put and a higher strike call against it, or buy a higher strike put and sell a higher strike call against it, and basically reestablish this collar, rolling it up or rolling it out further out in time. So once again, there's no right or wrong answer. It's all going to be dependent upon your individual forecast, your individual risk tolerance. All going to be different depending on what you, the individual. There's no right or wrong answer here. It really is all going to be dependent on your forecast. So one really cool example using the collar, and many of you probably have heard of the story, but it's a great story. So many of you know who Mark Cuban is. He's the owner of the Dallas Mavericks, and you see him on Shark Tank, and he's worth multiple billions of dollars. Well, in 1999, this is actually one of the 10. It's actually known as one of the 10 top trades of all time in the stock market. So in 1999, for those of you who don't know, Mark Cuban sold his company, broadcast.com. It was a streaming and audio video business. And remember, 1999 was kind of at that, just as the internet bubble was peaking. Well, Yahoo came along, the company, when Yahoo was still around, came around, and they bought Cuban's broadcast.com for $5.7 billion in an all-stock deal. So this made, based on Cuban's stake, he was worth roughly about $1.4 billion. So he received 14.6 million shares of Yahoo for his broadcast.com holdings. And part of the deal was he was subjected to a 3-year lockup, meaning he couldn't sell his shares, his Yahoo's shares, for 3 years. And Cuban, being a savvy investor that he is, said, well, I really don't want to own Yahoo stock for 3 years when we're clearly in an internet bubble. At least I'm going to put on a hedge. So what he did is he went to an investment firm, and he structured a cost-free collar. What he did is he went out 3 years, and he bought the 85 level puts. So I believe the deal was struck right with the stock trading around $95. He bought the 85 level puts 3 years out, and he sold the 205 calls. And because the pricing structure in the market at the time favored out of the money calls, because there was a negative skew in the market, because remember, it was the internet bubble and the upside was priced a little more expensively than the downside, he was able to put this structure on for even money. It didn't cost him a penny, other than maybe some commissions and fees that he had to pay. So you fast forward to 2000, you fast forward to 2000, and Yahoo shares peaked at $277. Okay, so it looked at the time like Cuban left a lot of money on the table. He basically left $1 billion on the table because he sold the 205 calls, and now stock's trading 277. Okay, but then you fast forward to 2002, Yahoo shares cracked, and they ended up trading 13. He was able to exercise his put, sell shares at 85, and he locked in roughly 90% of the value of this giant, massive Yahoo stock holding. So once again, this is just a real world example of the collar in action. It's just a great story. And we all know that that's really how Cuban made his first billion. And then he went on to make billions more, making savvy investments. But once again, just kind of a real world example of the collar in action. Okay, so let's look at some variations of the collar. So some creative ways that you don't necessarily have to, buy a put in 1 month and sell a call in the exact same month. So the staggered collar, what if we bought longer dated protection and sold shorter dated calls? Okay, so what are some of the risks and what are some of the benefits? So some of the advantages of doing a staggered collar. When you sell near-term options against farther-term options, anytime you sell options, okay, those options are subject to time decay, but time decay doesn't decay. The time decay, your decay known as theta, doesn't decay in a linear fashion. So options that expire anywhere from 30 to 40 days out decay faster than options that are further dated. So the closer and closer you get to your options expiration, the faster and faster those options decay. So by putting on a staggered collar, you're taking advantage of that near-term decay on your shorter dated calls. And if the calls are unassigned, you can continue selling shorter dated calls and hopefully whittle down the price that you're paying for that further dated put. Obviously, if you buy a further dated put, that's going to cost you more just because of the time premium involved. But the idea is you continue to sell shorter dated calls to help fund that position, for the put. So longer dated puts obviously cost more premium. So the shorter dated calls are less premium. So you're always going to be putting on a staggered call probably for some kind of net debit. Okay. And because we're putting it on for a net debit, a large move in either direction really favors the traditional collar, because the traditional collar is typically put on for either a small debit, even money, or possibly a credit. Okay. So anytime we put on a staggered collar and the stock moves, that just means we still defined our risk to the downside, except we might lose a little more on the downside. Our effective maximum loss would be a little greater because we're paying a higher debit for that overall position. Plus, on the upside, our any profit that we would make between the share price that we paid for the stock and our short call would be diminished by any debit that we took in for the entire structure. Okay, so just some kind of pros and cons. So let's look at an example. So we have Tom, who has bought a Bubble, a fictitious soft drink maker. Okay, and due to better expected earnings, shares have run up, and he's long 100 shares from $82, and the stock is currently trading 96. So he's looking to protect some of his unrealized gains against future earnings reports. So he's looking to an options collar. So he looks out and he sees that he can buy the Dees 92.5 put for $11.20, and he can sell the April 100 calls for $2.75. Okay, so this whole structure, as you can see, is going to cost him, what is that, $7 and it's $8.45. So it's going to cost him $8.45 to put on this entire structure. So he's going to pay $11.20 for the put, and he's going to sell the call for $2.75. So the idea is he'd like the stock to just kind of, stay, right around where it's trading, or maybe gravitate up to the 100 strike. Ideally, he would like the 100 strike to finish out of the money and expire worthless. And now he can repeat the sale of the short calls, maybe selling the 100 calls in May, or the 105 calls in May or June, and just continue to whittle down that debit that you paid for the overall position. Every time he sells calls that expire worthless, it reduces the overall cost of this long D split. And once again, the short-term theta is working in your favor, because theta, the Greek known as theta, is a friend to option sellers and a foe to option buyers. Okay, and by buying longer-term options and selling shorter-term options, theta now is your friend, and it's helping you in this case. Okay, so what happens if we put on a staggered collar and the stock moves sharply lower? Well, once again, you own that long put, and you always have the right to exercise that put and sell your shares out into the market. But because you're buying a longer dated option, that put probably is going to have some significant time value left in it. So by exercising a put early exercising any option early with time value in it. You're certainly free to do that, but you would lose any of the time value left in that option. Okay, that would be foregone and go to the, whoever got assigned on your option. So if your option has any extrinsic value left in it, you'd be better served by just selling that put out into the market and monetizing your hedge that way. You could always hold the put and keep selling lower strike calls against it. In other words, buying back your higher strike, in this case, the 100 strike, and maybe stock goes down to 80 and you could sell the 85 level calls or 90 level calls, that kind of thing. That's always something you can do. And in this case, you'd be lowering your potential assignment price, but at the same time, you're still whittling down the cost of that hedge that you put on the put. If the stock moves higher, well, assignment could result in a lower profit because in this case, due to the lower premium that you took in for that surety call, because you're paying a debit for that position, it's going to lower your effective profit on the upside. So once again, remember, in any covered call position, your upside profit potential is the difference between the strike that you sold and the purchase price of your shares minus any debit that you paid. So greater amount of debit is going to decrease that potential profit to the upside. But once again, if that stock starts rallying to your short strike, you can always buy it back. If the stock starts rallying to 100 and I'm getting a little nervous, I can buy back my 100 level call. I can roll it up to the 105 strike or the 110 strike, either in the same month or further out, and afford myself further upside on the long stock position. All right, so there's another variation, and this is called a put spread collar. Okay, and I think somebody last week asked about this. So this is your standard options collar, but in this case, maybe we're going to put on a put spread collar if we think that the shares have maybe are going to go down maybe 10%. We're worried about a 10% move, 20% move, a 30% move. If I buy stock for 100 and I buy the 90 level puts, okay, I have protection from 90 all the way down to 0, right? But if I'm buying a very stable company, I mean, granted, anything can happen in the market, but if it's a household name and it's a strong balance sheet, what's the likelihood of a real household name going to 0? It's probably pretty unlikely. So do I really need all that insurance? Do I need insurance from 90 all the way down to 0? Well, maybe not. So now maybe I'm going to consider putting on a put spread collar where not only am I going to buy a protective put, but I'm going to sell another put against it to help mitigate the cost of this hedge. At the same time, now what I've done is I have protected myself, but to a limited degree. So once again, by selling a further out of the money call, we might be able to either put this position on for net credit or increase the original credit that we put it on by selling this out of the money put. So in this case, we'd be long stock, short and out of the money call to the upside, long and out of the money put to the downside, and then short a further out of the money put against it. So sometimes this is referred to as a fence, an options fence, because you're kind of putting a fence around your stock position. It doesn't mean you don't have risk. You still have risk to the downside, but you're essentially putting a fence around the stock position, a fence to the upside and sort of a limited fence to the downside. So let's look at the put spread collar example. So we have Karen. She bought 100 shares of the fictitious athletic wear company, Jogger, and she feels has some long-term potential, but she's also concerned with some upcoming earnings. So she's looking for a little downside protection in the short term, but she doesn't expect a large decline. So these are possible strategies. She could buy a protected put outright, but that may be expensive. She could place an options call around her position, providing her downside protection down to 0, or because she doesn't anticipate a large decline, this is when a put spread collar might fit. So she anticipates the potential decline to be a modest one, so she decides to put on the put spread collar. So this is what that looks like. The traditional collar, if she was going to put this on, she would pay $3.60. In this case, she's long stock from 100 shares. I'm sorry, she's currently long shares from 105. Stock is currently trading 120, so she's sitting on a $15 gain. She looks out and she says she sees that she can buy the 115 put for $3.60. She can also sell the 125 call for $3. That would, just putting on that collar by itself, would result in a net debit of 60 cents. But she wants to put on put spread collar. So she's going to look out and sell the 105 put at $1.60. So in other words, she thinks there's a very low likelihood of the stock going down, roughly 12.5%. So she sells the 105 strike put at $1.60. She's able to put this whole structure on now for $1 credit. So what does that look like? So if at expiration, the stock is, say stock closes, maybe stock dips and stock goes back down to 105. Well, she's going to give up the $15 that she made on her long stock position. Her 115, 105 put spread is going to be worth its maximum of $10. But remember, the put spread by itself, she paid $2 for it. She paid $3.60 for the 15 put, sold the 105 put for $1.60. That's a $2 debit. She's going to make $8, and her 125 call is going to expire worthless, or she's going to keep that $3. So it's a total profit of $11. So if the stock goes to 105, she's still going to make $11 on this position. Okay. If the stock goes higher, okay, let's say the stock goes to 125. Well, if the stock goes to 125, she's going to make $20 on the stock position. The 115, 105 put spread would expire worthless. She would lose $2 on that position, but she would still make $3 on the call going out worthless. And in this case, a maximum profit of $21. So in this case, the most she can make on this position is $21 with the stock at her long or short call strike 125 or higher. Unfortunately, if the stock goes higher up, up to 135, yes, she's still going to make money, but now she's going to forego any gains between 125 and 135. If the stock goes south, in this case, let's say stock goes to 95. Well, at 95, she's still going to make $1. Okay, it's not a lot, but she's not going to lose money. Okay, she's going to lose $10 on her stock. Her 115, 105 put spread, she's going to make $8 on that spread. She's going to keep $3 from the sale of the 125 call. When you net that out, that comes out to $1. So she's not going to be out of pocket. So by putting on the spread to the downside, it's really helped her avoid losing much money. Okay, she kind of, in this sense, kind of breaks even. So let's look at this exact spread in graph form. Okay, so as you can see, in this case, we've capped our upside at 125, and we've protected our downside. Okay, so what's our break even on this? Okay, so our break even in this case is going to be the lower put strike. In this case, 105. Okay, we can make $10 on this put spread. Okay, so we own the 115 put and sell the 105 put. We can make $10. Okay, so we have protection in this case down to 95. But remember, we put this whole structure on for a net credit of $1. So that gives us a break even on our shares at 94. Okay, so in this case, this is where the fence kind of kicks in. The fence is really between 94 and 125. Okay, if the stock breaks 94, it goes to 50. Well, now our protection we're no longer afforded protection, and we're going to have one-for-one losses on our long stock position. But our effective break even in this case is $94 by putting this whole structure on. What's our maximum profit? Well, it's going to be our short call strike, 125, minus the price that we paid on the stock. And this is 105, plus any net premium, okay, because we took in $1 credit. When you do the math, that gets us to $21. So the most we can make on this position is with the stock at 125 or higher. At expiration, we would make $21. And your maximum loss in this case is from 94 all the way down to 0. Okay, so your protection only exists in this case between the 115 and 105 strike. Okay, you've got $10 of protection between 105 and 95. I'm sorry, 115 and 105. You have $10 of protection, but because the whole structure, because of the structure, your break even is really at $94 in this case. Okay, so now let's look at one last variation. This is called the laddered collar, okay? Now this is kind of a hybrid. This is where we're gonna buy a longer dated put, and we're gonna sell various call strikes at different expirations. So we're kind of, doing that staggered collar, but we're doing it at different expirations. And you can only really do this if you own, you're putting this position on in a position you have more than 100 shares. Okay, so let's look at an example. This person has 500 shares. That's stock's trading at 100, and they're looking for 6 months out. They're looking for protection, so they buy the 85 level puts in this case for $4. Now they go out and they sell the 30-day 105 calls for 75 cents, the 60-day 110 calls for 80 cents, the 120-day 115 calls for $1.80, and the 180-day 120 calls for $2.50. Okay, so if we just bought these puts outright, 5 of the 85 puts for $4, that would cost us $2,000. But because we have sold different strikes at different maturities, we've taken in a blend of different premiums. This debit, we whittled this debit down from $2,000 down to $1,165. Okay, so also keep in mind that if the stock moves higher, we have afforded ourselves more upside because we sold different strikes. Okay, in 30 days we capped ourselves at 105. 60 days we capped ourselves on 100 shares at 110, et cetera, et cetera. So we've afforded ourselves more upside by selling further dated calls, and at the same time, using that idea of selling near dated options. The 30-day option is going to decay quicker in this case, and if that option expires worthless, now we maybe sell another 105 call against it. Okay, so it's just, once again, the idea is hopefully all these calls expire worthless, and we can continue to sell and roll the position to different strikes and whittle down this net debit of $1,165, and hopefully at some point, put this whole position on for even money or even possibly a credit if we're able to do this over and over and over again. So once again, if the stock makes a sharp move in either direction, what can I do? Well, once again, option positions are never set it and forget it strategies. Okay, so you want to have a plan if all of a sudden the stock makes a big move down or a big move up. Okay, well, once again, if a stock makes a sharp move down, you always have the right to exercise that put and buy your calls to close the position. But if you're buying further dated options, if they have a excessive amount of time premium left in them, you'll be better served just selling out that put rather than exercising it. Okay, you're really exercising a put if, one, you want to get rid of the shares, and two, those options don't have much time premium left in them. If all of a sudden the stock makes a big move to the upside, okay, some or all the calls may be assigned and the stock gets called away at various intervals. Okay, but remember that when you put this position on, when you put this position on, you sold various strikes. So maybe you're comfortable selling a little stock at 105, a little bit at 110, some at 115. That might be part of your plan, okay? And that's perfectly okay. So, by selling, and that's the whole idea, you're selling your stock at various prices, at better and better prices to the upside. So you've afforded yourselves more room to the upside. But if all of a sudden the stock makes a quick move in the near term, you can always buy back those short calls and roll them to higher strikes to help to give yourself more room to the upside. So, once again, all things you can do from a position management standpoint. So regardless of what direction the stock moves, because you're collecting less premium for the shorter dated calls versus the longer dated puts, remember we put this position on for a net debit, okay, that's going to increase our maximum loss to the downside. It's also going to decrease our maximum profit to the upside should we get assigned on all our calls. Okay, so once again, it's it's any position that you put on, it's going to be different for everybody, and once again, that's going to be different depending on the strike selection you pick, prices that you're receiving and paying for those options. Once again, anytime you're looking at this, it's really going to help you to have an idea of the implied volatility levels that you are buying and selling, so you can make a really good educated choice about if this position fits your forecast. Because once again, and anytime you are buying and selling options, you will really want to have an idea of whether those options are expensive or cheap. And the last thing you want to do is buy overpriced options and sell underpriced options. Okay, and having an idea of implied volatility will help you. We have videos on our website that can walk you through understanding implied volatility, but that's something that also is something you want to consider when you put this position on. Okay, so some takeaways. An option collar, a traditional collar, is comprised of a long put for protection on the downside and a covered call on the upside. So with the long put, you can always exit the position at your strike price. From the short call, your profit potential is limited by that short call strike. So you're capping your losses to the downside, but you're also capping your gains to the upside. So variations also that we talked about: the staggered collar, the put spread collar, the laddered collar. Okay, there's all varying degrees of advantages and disadvantages. But these are all creative ways that you can structure this position to fit your investment objectives. Okay, so with that, I know we have some time remaining, and Matt and Mark and Roma have all been answering questions. So I'm going to bring Mark on really quick, but for more information regarding this topic or any others, you can always reach out to us at optionseducation.org to view our free online education course and all the other resources that we have. You can always send us emails with your options questions to options@theocc.com, Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time. And you can also check out our YouTube channel, where we have archived many of our past webinar presentations. So I just want to put that out there for your reference. And Mark, I'm going to bring back Mark and see if we can answer some questions live. Mark, are you there?
Hi, Ken. Yeah, thank you. I certainly am. Can you hear me all right?
You sound great. I can hear you fine.
Oh, okay. Good. You worried me for a second there. Number one, Ken, terrific presentation. Great information. There's a couple questions that came in that all have kind of a similar theme. I know when it comes to protection, you were talking about protecting yourself maybe against a 10% decline in the market or a 10% decline in the security, what have you. A couple people have asked, rather than use a percentage as a guide, or, I'm willing for the stock to drop $5, but not much more than that. Do you use delta at all when selecting strikes, or when composing this collar in any of its variations? Do you use delta to select a strike, or do you really more look at it as a target of what price, do I want that protection to kick in?
Yeah, I think, from a trading perspective, you'd really kind of want to ask yourself how much you're willing to lose on the downside and how much you're willing to cap yourself on the upside. I mean, you could certainly use delta, but, obviously, when you put on a collar, okay, that position's going to have a negative delta, right? You're going to buy a put and you're going to sell a call. Each of those individual positions have a negative delta, okay? So depending on which strikes you pick, if you pick a higher strike put and a lower strike call, that's going to increase your delta. Yes, that's going to increase your overall protection, I guess, on that stock or portfolio. But at the same time, it's going to it's not going to afford you as much upside on your long stock position to the upside, the lower strike calls that you sell. And on the put, the higher strikes that you pay for your put, it's going to cost you more to purchase those puts. So, ideally, the idea is people who put on collars, they're not really putting them on hoping that the stocks fall apart. It's more like protection. It's like when you buy auto insurance, nobody hopes to get in an auto accident, but you buy it just in case something happens. So, typically you kind of have to ask yourself, well, what am I comfortable with? Am I comfortable if I buy stock at 100? Am I comfortable with a 10% loss to the downside or a 5% loss? So once you kind of figure out what your pain points are, where you're comfortable, selling your shares. Now you can figure out, you can target what protection you need both to the downside and also which, call you want to sell to the upside, how much upside participation. If I think if I buy stock at 100 and I think the stock is going to go to 120, okay, make a 20% move. Well, it doesn't make much sense to sell the 110 call regardless of whatever price I'm getting for it, right? It's kind of, it doesn't fit my investment objectives, then I'd probably target the 120 or 125 level call. So, you really have to kind of map out what your forecast is on the stock, and that's going to go a long way to helping you determine what strikes you want to pick. But, once again, you could use delta, but most people just kind of, what I talked about, just figure out where their pain point is on the downside, where they're willing to lose shares on the upside, and that kind of will help you determine what strikes to pick.
Right, and that's an excellent point in terms of strike selection. Where do you want that protection to kick in, and then where are you willing to give those shares away? And that kind of ties in with another question that a few people had asked relating to time. How much time should you be looking to purchase on that put side? When putting on either a protected put or a collar. And obviously my response, and feel free to add to it, was, just making sure that the time that you purchase encompasses the event of which you're looking to protect your stock or portfolio from. Obviously, if we've got earnings in 3 weeks, it doesn't make sense to put on a collar for only 2 weeks, because that's not going to encompass that risk that we're looking to protect from. Do you have anything? You have anything to add to that?
Well, also on the same note, if you're hedging an earnings event that happens in 3 weeks, you don't want to buy a put that expires in 2 weeks, but you also don't want to buy a put that expires in 12 months, probably, right? You just, if you're hedging a binary event, kind of like figure out where, how much, you don't want to buy more insurance than you need, right? Okay, so and if I own $1 million house, I don't want to buy $2 million worth of insurance. It just doesn't make any sense, right? So it's just kind of overkill. So you just have to kind of figure out where, what you're hedging, what your time frame is. Also, keep in mind that you're also, when I talked about implied volatility, the further you go out in duration on your option, on the option curve, further out in time, the more expensive those options are going to be, because the more time premium that you're paying for those options, the more vega heavy those options are. And implied volatility affects the further dated options more than the near dated options. So where theta affects the near dated options, the shorter dated options decay harder and faster, the longer dated options are more affected by changes in implied volatility. So if you're putting on like a staggered collar or a laddered collar, you really want to have an idea of the levels that you're buying further out to know, like, okay, am I buying options that are currently really expensive right now? I mean, or not. So you want it, and that's going to have an effect on your overall the price that you the net debit that you pay on that position. Because ideally, like when you put these positions on, you would like to put it on for even money or even a credit. You actually get paid to put this position on. So, but in the case of a staggered collar or a laddered collar, most likely initially you're going to be paying a debit of some kind, but you don't want to overpay for that debit if you're buying very high and inflated implied volatility. So once again, it kind of goes a long way to analyzing the levels that you're buying and selling, just to make sure that you're making a very good and educated decision on the type of structure you're hedging. So, yeah.
Right, and your point of not buying more protection than you need, that's one of the things that I find most attractive about, for example, the put spread collar, or really spread trading in general. Why buy a call option that gives you unlimited upside potential if your forecast is only that the stock is going to make a 10% move? Same thing with the protected put or the put side of the collar. Why pay for that protection from, your strike price all the way down to zero if you think the stock is only going to make a downward move of, between 80 and 90, I think was the example used. So just, a great example using spreads in different ways to accomplish different things. Again, why pay more than you need to? I think that's an excellent point.
Exactly. And also, like when you're putting on that put spread collar, you're taking advantage of the options skew. And the skewness in options is the idea that typically, if you're looking at a $100 stock, the 10% out of the money calls are going to be trading at a lower price than the 10% out of the money puts in general. Typically, there's this skew to the downside, and that's because stocks tend to go down harder and faster than they go up. And it's that whole adage where the market goes up on a staircase and it goes down in an elevator, and it's very much the case. So because the velocity is harder and faster to the downside, in most products, most stocks and indexes, you will see this skew to the downside where the out of the money puts tend to be more expensive than their corresponding out of the money call counterpart. So by putting on a put spread collar, you're kind of taking advantage of that skew. Yes, you may be buying an option that's expensive in terms of implied volatility, but you're equally selling a more expensive option in terms of implied volatility by selling a lower strike put. So you're kind of using that natural skewness in the options market to kind of your advantage by putting on that put spread collar. The only downside is, your protection ends at that short put strike. So, if you're calculating that I don't think the stock is going to make a greater than 20% move, but then all of a sudden the stock falls 40%, that's going to be unfortunate. You're going to lose below, your short put strike. I'm sorry, your protection is going to cease to kick in below your short put strike, and you're going to lose 1-for-1 on your shares. So, pros and cons. There's no right or wrong answer, but certainly the put spread collar makes sense if you see limited downside for your shares. And once again, by selling that out of the money put, you can take advantage of the fact that those puts are probably a little highly priced in terms of implied volatility.
Yeah,